how to navigate around the complex rules of transfer pricing and the fact that we now are facing the most extensive changes within 50 years with respect to international corporate taxation is something that BDO advisors Maria Hyckenberg and Pinar Gagin can tell us all about. Thank you for joining us today and welcome.
Thank you, Jenny. Thank you for the nice introduction, and it's a pleasure to be able to be here today and talk about what's going on and what is new in the field of international taxation in general and transfer pricing in particular. And as you mentioned, we are in the middle of an extensive and comprehensive change of the rules and principles with respect to international taxation. And those changes that we experience today are probably the most transformative changes that we have seen in over 50 years on a global level. And it is clearly indicating that taxation is no longer only a matter of national matter, but also a global issue that needs coordination and cooperation between different countries in order to align the tax systems. Knowing that we only have approximately 20 minutes to our disposal today, I would still like to go back a bit in history and try to describe the big drivers and incentive that we have seen behind those changes that we are experiencing as of today. And in the recent 10 years, there has been two major incentives on a global level that has affected the tax systems in different countries. And the first one I would like to mention is an incentive by OECD. It's called the BEPS project. And it's about finding coordination, substance, and transparency in a common tax system around the world. And it's also about counterfeiting, tax evasion, and profit shifting and base erosion, which has actually been a problem in an international context for many years. And the other incentive that I would like to mention is an incentive by the European Union. And it's an incentive that came a couple of years after the BEPS project started. And it's also about preventing aggressive tax planning, but also try to coordinate the implementation of the different action points coming out from the BEPS project in between the different member states of the European Union. And to some extent, the BEPS project and this EU incentive called the Anti-Avoidance Package, or ATAB, is pinpointing the same kind of issues, but the EU incentive is also going a bit beyond the BEPS project and is, for example, entailing a general anti-avoidance rule applicable to the member states, and also, to some extent, exit taxation when you move assets out from a country into another country. And it's also pinpointing taxation on dividends and capital gains to some extent, which is not mentioned under the action points in the BEPS project. So some similarities, but not exactly the same. That's the major two incentives on a global level that we have seen during the 10 recent years.
So what changes have we already seen now then in these projects as a result of BEPS and the ATAD?
Well, there is quite a lot of changes. I mean, since this is processes that has been going on for 10 years approximately. But to mention some of the changes from a Swedish perspective, we have seen and implemented new interest deduction limitation rules, which are applicable on interest deductions in general, both on external loans and on internal loans. Before, Sweden has applied interest deduction limitations on intragroup loans, but not we have not had a general limitation on interest deductions. So this is one of the changes. We have also seen changes of the Swedish CFC rules. We have also seen updates of the OECD guidelines in different respects. One that could be mentioned is with respect to permanent establishments and profit allocation. And we have also seen, as a result from the ATAD, we have seen new rules aiming at transparency called mandatory disclosure rules, which basically implies that tax advisors and tax lawyers are obligated to report certain arrangements to the tax authorities in the specific country. And of course, this is aiming at the tax authorities can exchange this information in between different countries.
A lot of changes indeed.
A lot of changes, definitely.
And what are the most recent news then with respect to BEPS?
The most recent development is with respect to action point number 1 of the BEPS project, and it's targeting the new digital economy. And in order to explain these actions a bit further, one of the greatest challenges as of today is to adapt the global tax system into the new digitalization of the economy. I mean, the current traditional tax systems in the different countries around the world, they are based on the notion that physical presence is a prerequisite for taxation. But in a new digital economy, we have digital enterprises and digital services which do not require physical presence in order to generate revenue. You could mention, for example, streaming services, advertising services, online advertising, and multi-sided platforms like Uber, Airbnb. Those kind of services, they don't require physical presence, but they have clients and customers, users in many different jurisdictions. So in the jurisdictions where you have consumers of those services, politicians and tax authorities, they feel entitled to be able to tax parts of those profits that are generated in their countries. So that's a major problem with the current global tax system. And to elaborate a bit on that, it's also a problem that the current or traditional tax systems, they are based on taxation of IP rights, and IPs can be moved anywhere around the world. So if this should be the base of taxation, it's very easy to start a race towards the bottom when it comes to tax rates in order to attract foreign investors and make them put the IPs in their country in order to be able to allocate profit to that specific country. And the OECD initiative under Action Point 1 is trying to target those problems with the digital economy as of today. And it has resulted in 2 reports, so-called blueprints, or OECD Pillar 1 and Pillar 2. And the first releases of those reports came approximately a year ago in October 2020. But there was some still unsolved issues with respect to those reports. So this autumn, we have seen releases of updated reports in this respect. And to explain a little bit more in detail on those reports and what they entail, I can start with Pillar 1, the first blueprint or report. The ultimate purpose of this Pillar 1 is to shift parts of large digital service providers' global profits to the market jurisdictions. That is the jurisdictions where the consumers or the users are located. And initially, Pillar 1 is only applicable to very large multinational companies with a global annual revenue exceeding 20 billion euro and with a 10% profit margin before tax. So it's really large corporations that will be these rules will be applicable for. So The rules under this Pillar 1, it says that it entails a reallocation rule. So some of the profits that those multinationals create or generate in a certain jurisdiction will be reallocated to the market jurisdictions. And this, even though it's only large multinationals that will be targeted under those rules, initially at least, this is still having a large global impact. Just to mention a number, the OECD is estimating that $125 billion will be reallocated due to these rules. So it's large amounts. From a Swedish perspective, it is fair to say that we don't have many multinational enterprises exceeding those very high thresholds. So Sweden will not have any significant impact of those rules, at least not initially. But the long-term incentive is to lower those thresholds and make the rules applicable to smaller corporations as well. And in the long run, when the Swedish companies also will be targeted by those rules, it is fair to say that Sweden is a small market and we are focused on export in our country, so we will definitely be on the downside of those rules. I mean, in that sense that Swedish companies will most likely pay more taxes in other countries than foreign companies will pay in Sweden. Yeah. So I think that's the first report in a very short version.
The winter is coming.
Yeah, the winter is coming, definitely. Moving on to the next report, the next blueprint called Pillar 2. And the main purpose of this pillar is to impose a global tax system with a minimum effective tax rate of 15%. And it will also be applicable only to large multinationals with a global annual revenue exceeding 750 million euro. So it's also targeting very large corporations. And it sounds fairly straightforward to impose a global tax system and a minimum tax rate. But this rule is quite complex with a lot of different elements included. And to mention some of them, there is a income inclusion rule implying that if a parent company has a subsidiary in a low tax jurisdiction, under certain conditions, there will be a top-up tax of the parent company so that the income of the subsidiary is taxed in the country of the parent company. So, and there is also other elements that will try to raise the global tax rate and make sure that revenue that is generated in low tax jurisdictions will be taxed in the jurisdictions with a higher tax rate. And of course, this rule will not have any direct effect on Sweden because we already have a tax rate exceeding 15%, but indirectly it will most likely have a large impact on Swedish multinational groups and give rise to a lot of restructurings within groups, within multinational groups. So, yeah.
Up until now, we have only briefly mentioned the transfer pricing. But when it comes to international corporate taxation, it's impossible to not go into the transfer pricing area, since that is the most important issue on the international corporate taxation. Pinar, as a transfer pricing specialist at BDO, you will update us a bit on transfer pricing. But first, I would like to ask you, most of the BDO clients are not large multinationals. Do they really need to worry about transfer pricing?
Definitely. Thank you, Janie. Transfer pricing is known that it is only a topic for very large multinational companies, but no, it is not. Historically, we have mostly discussed transfer pricing with very large multinational companies. But nowadays, it is different because we live in more global world. Even small and medium-sized companies have cross-border transactions. So definitely, it's a question for small and medium-sized companies. Transfer pricing is one of the most important international tax issues for both large, small, and medium-sized companies. I want to emphasize two very important points on transfer pricing practices of small and medium-sized companies. First one is, independent from the size of a company, having a transfer pricing structure can help a company to manage the tax costs and can reduce the tax risks. Transfer pricing is important for the tax cost management within group. Tax costs can be reduced by the compliance with transfer pricing regulations. The second one is not having a transfer pricing documentation as a legal necessity because of being turnover threshold does not mean that a company can avoid tax disputes with the tax authorities in case of not compliance with arm's length principle. Because of these reasons, both small and medium-sized companies definitely need to have transfer pricing model.
So what is the tax authority approach on TP practices of companies?
There has been international focus on transfer pricing practices. In line with OECD guideline, transfer pricing rules are becoming more complex. BDO also confirmed with its own survey that transfer pricing is one of the most complex tax issues. In recent years, tax disputes in cross-border transactions have significantly increased. Tax authorities generally criticize the profits that look unrealistic. A company may not try to avoid the tax, but still, in case of the profits they make are not arm's length, and this will be questioned by the tax authorities. Historically, there has been very strong focus on documentation. There are certain countries like Denmark, they have penalty fees in relation to not having transfer pricing documentation in place. But in Sweden and many other countries, the approach of the tax authorities changes. They focus more on the substance of the principle that the company has in its transfer pricing documentation. So it is really important how the company proves that it fulfills all the requirements in line with transfer pricing documentation. In Sweden, we don't have any penalty fees in relation to not having full documentation, but transfer pricing affects corporate tax. And penalty fees applying to the companies are in relation to the adjustment of the tax. For tax authorities, it is easier to impose transfer pricing adjustment and recalculation of the tax to be paid. Therefore, it is even more important for Swedish companies to fulfill the arm's length principle. And companies need to have good support in the transfer pricing documentation, showing that they are applying arm's length principle in each transaction they perform.
I see. So how can BDO help your clients to navigate around the complex rules of transfer pricing?
We have full service package for transfer pricing. We can help with transfer pricing planning and structuring and transfer pricing compliance. One part is transfer pricing planning and structuring. In this part, we assist our clients in determining the transfer pricing policies of their intercompany transactions in line with transfer pricing rules. And also we consider all international tax aspects in different jurisdictions. At first, we perform functional analysis interviews with the key departments of the companies in order to understand the functions, risks, and assets of the companies and their role in the value chain. Based on that, we categorize all group companies in line with their function analysis. At the same time, We analyze groups' financing and intangibles from transfer pricing perspective, and we perform economic analysis, and we analyze all intercompany transactions of the companies. Then, based on function analysis and the economic analysis, we advise on a transfer pricing policies of intercompany transactions of the companies in line with transfer pricing regulations and aligned both operational and legal perspectives. The second one is transfer pricing compliance. We assist our clients with local file, master file, and company agreements they need.
Thank you, Pinar. Well, there is a lot of information to process in this area. Maria, how would you like to sum up today's discussion?
Well, there is a lot of things to be said in this respect, but I would actually like to also be able to pinpoint the COVID pandemic that we have suffered from in the whole world, and the effects that this will have on tax, on international corporate taxation in particular. And I mean, a lot of countries around the world, they have suffered large budget deficits due to the pandemic. And in some recent future, there will have to be changes in order to bring in money to the states. That's the basics. And from my perspective, there is only two ways of doing this. One is to cut costs, and the other one is to raise taxes. And states has, according to my experience, never been good at cutting costs. So most likely we will see, from an international perspective, a raise in tax levels around the world, in tax rates. And also, I think it's important to acknowledge that in the footsteps of this, we will also see a decreased tax control, tax audits, in order to make sure that you secure tax payments in different countries. So I would say that according to my experience, the tax will be on the agenda of both politicians, board members, management teams all around the world, in order to keep ahead in this field. Yeah.
Which kind of actions are you at BDO recommending your clients to take in order to mitigate the tax risk?
Yeah, well, based on what I just said, I would think that a good advice is to put tax on the agenda, to make sure to have a structured plan, when, especially if you have a multinational corporation and are present in many different countries. It's important to acknowledge all the changes that are coming up. And second of all, I think due to the fact that we will most likely see an increase of tax audits, it's important to be compliant, and that is in every area. So make sure to be in control of your CIT returns, your intercompany agreements, your transfer pricing documentation, as Pinar mentioned. That is really important, and to also put TP structuring and modeling on the agenda. I think that's a good advice, to be reassured that you are keeping ahead of all the changes that are coming up, because there are a complex situation for many companies right now.
Thank you, Maria and Pinar, for joining us today, and thank you for watching. For further information and advice regarding international corporate tax and transfer pricing, you are always welcome to contact BDO.